Of course, we should focus on real wages rather than nominal wages. By that measure, is the typical worker really better off this year than he or she was a year ago?
Yes. Yes, I would say that the labor market has strengthened. The labor report will show that wages went up 2.7%. That's significantly higher than trend inflation. There is a bit of a bump from gas prices going up, and consumers do pay that. But I would say that overall workers are better off.
I would partially contradict that, say that non-supervisory workers, 4 out of 5 workers, have seen nominal wages go up, but real wages haven't by those same BLS statistics. Let me move to another. You've called stress testing the most successful regulatory innovation of the post-crisis era, but the action, you said that some time ago, the actions the Fed has taken during your tenure undercut that effectiveness. The Fed gave Goldman, Morgan, and State Street passing grades this year, even though they failed to meet capital requirements in CCAR, the first time that's ever happened in CCAR history. The Fed proposes to weaken the leverage constraint in CCAR, reportedly may drop the qualitative portion of the test, wants to give bankers more leeway to influence the Fed's models, and may soon adjust Dodd-Frank stress tests to make them less stressful and less frequent, hence the periodic. Stress tests were adopted in 2009 to provide confidence to the public that the banks could weather economic shocks. How is the public supposed to trust the stress tests when the Fed proposes in all of those ways to weaken them? We're strongly committed to using stress tests. We really developed the supervisory stress test at the Fed, and as you know, we think it's a very important tool. It was one of the main ways that we used to raise capital, particularly among the largest firms. And we're committed to continuing stress testing as one of the 3 or 4 most important innovations, along with higher capital, higher liquidity, and resolution. It's one of the big 4 pillars for us. The program has to continue to evolve. We want to strengthen it. We want to make it more transparent. We want to improve it over time. And that all of our actions are designed to do that. And I think if you look at the state of the banking system and the fact that this test will require higher capital, then I think you'll see that's consistent with, that our words are consistent with our actions. Well, I think the message coming out emanating from the business press, and those are not, Democratic liberal newspapers, they are the Wall Street Journal, Financial Times, the New York Times business section, speaks to the fact that these stress tests are getting weaker. Let me ask another question. Vice Chairman Quarles has given 2 speeches outlining how the Fed wants to recalibrate the rules for large foreign banks. You gave an answer, a carefully worded answer, I thought, to obscure the fact that large foreign banks may receive less oversight as a result of 2155. The public's getting mixed messages from the Fed. For the record, can foreign banks with more than 50 billion in U.S. assets, Deutsche, Santander, Credit Suisse, the others, can foreign banks with more than 50 billion in U.S. assets, can they expect to get regulatory relief during your tenure?
I think I can say that 2155, it's not clear to me how it provides regulatory relief to those firms. I mean, all of the banks that have 50 billion in U.S. assets have more than 250 billion in global assets. So I don't think there really will be much effect. I won't say that we'll never do anything to provide regulatory relief to a group during my tenure, but
so your position seems to be that if they're over 50 in the U.S., under 250 as those are, but much, much, much bigger with all the globally, that you don't expect any regulatory relief for them.
Well, the main thing is the $50 billion threshold for internal holding companies will remain the same. We're not looking at that. So I think they won't see much difference.
Physical commodities, the Fed proposed physical commodities rule from 2016. You are moving presumably to finalize it. The Fed responded to questions for the record saying that the board continues to consider this proposal. When can we expect action on it, Mr. Chairman?
I don't have a date for you on that. I know that we received extensive comments on it and we're considering them.
Do you feel some urgency on it?
I'll have to go back and look and see where that is in the line.
If you would please respond in writing to that. And last question, Mr. Chairman. The administration and some in Congress pushed through tax cuts and bank deregulation under the guise that it would trickle down to American families in the form of more loans. Loan growth has slowed in the last quarter.
It was less than half the growth rate than during the last year of the Obama administration. The four largest banks, as you know, redirected record levels of profits into dividends and stock buybacks. The four big bank CEOs got an average raise of 26%. My question is simple. When, if ever, do you expect to be able to come before this committee and demonstrate to us in this committee, as chair of the Fed, demonstrate to us how tax cuts and deregulation have actually benefited the real economy in the forms of more lending?
I guess I see my role as reporting about the overall economy rather than the effect of any particular law on it, although I'll be happy to take questions on that.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.